I'm Mike Morrissey, President and Chief Executive Officer of the IIS. And today we present the 10th in our series of webinars on the many aspects of the pandemic's impact on the insurance industry. Today, I'm very pleased to present University of South Carolina professor and longtime chief executive of the Insurance Information Institute, the renowned insurance economist, Dr. Robert Hartwig. Bob brings a uniquely broad and deep perspective on the industry to his presentation today, which is titled The Global Insurance Industry and the Challenges of Emergence from the COVID-19 Pandemic. And we'll have time for questions after Bob's prepared remarks, so I encourage you to submit them on the webinar platform, and we'll get to as many of them as we can. So Bob, thank you for joining us today from the Palmetto State. We're delighted to have you to share your insights, so please proceed.
Well, thank you very much, Mike. My pleasure to be here, and thank you to the IIS for providing me this platform to discuss this very important topic. But you've been on top of it for quite a while, this being the 10th in a series, and quite frankly, this topic continues to emerge rapidly, and there's no reason why you can't have 20 of these webinars over time, Mike. But hopefully, at some point, you'll be able to have an in-person conference once again, like the rest of the world. I know we all miss that kind of camaraderie around the industry and really around the world. So thank you once again. But without any further ado, let me give you a sense of what the discussion is going to be like for this presentation. And we'll talk a little bit about the scale and scope of the COVID-19 pandemic, just the latest statistics on that, because that sets the stage for the financial impacts on the P&C insurance and reinsurance industry, the impacts to date as best we know them and can ascertain them, and what they are likely to be, measured in terms of loss, premium impacts, investments, as well as a variety of other impacts. There's no question that the global economy is going to be the driving factor in terms of how this industry's growth proceeds in the months and the years ahead. And so we'll get into that in some detail. And then we necessarily will discuss some potential changes in the litigation, legislation, and regulatory environment before concluding. And by the way, this presentation will be made available to you on the IIS website, and it's also available on my website at uscriskcenter.com. So in terms of the latest data on the scale and scope of COVID-19, these are the numbers essentially that you keep hearing in every media outlet around the world. We've got more than 6 million diagnosed cases of COVID, and this number will continue to increase for a very, very long time, not only because the pandemic continues to spread around the world, but also as testing programs around the world are ramped up. As with all pandemics, you tend to see them make their way around the world at their own pace, and you see initially on the left-hand side of the screen, essentially all the cases in Western Pacific, meaning China effectively, and then migrating to Europe, which is what you see in green, and then by the time we're into early April, and then of course through May, we see the preponderance of cases in the Americas, first in the United States, and now we're seeing countries like Brazil report very large numbers of claims. So this has got some period of time to go, at least in terms of diagnoses. So while the worst may be over in some parts of the world, it is just peaking in other areas. In terms of actual mortality or death, we have the tragedy of about 375,000 deaths worldwide right now. In this chart, you see the daily count, and you really see the spiking beginning in early April. However, over the last week or several weeks, throughout much of May, in fact, you have seen a deceleration in the total number of deaths per day. And that has much to do with the fact that we're on the downslope in Europe, particularly countries like Italy, Spain, but also here in the United States. So that's good news, and that means that we are starting to see the reopening of many economies around the world, and I'll get to that in a moment. But in terms of the actual death rate, when we take a look at it, you see in terms of some major countries, Belgium actually leads the way here with a death rate of about 82 or so per 100,000 population. And we all know the tragedy that unfolded in Spain. in Italy as well. But the United Kingdom is up there. There's been much discussion about the Swedish model, in which they never really closed down the economy. And then you can see the U.S. Down near the bottom. And I put some other notable companies in the call out to the right here. Some of them very much in the news recently, as I mentioned, Brazil. Companies like Germany have been lauded in terms of their performance. However, you really do need to question the numbers in countries like Russia and Iran and China and in India. There's no question there are more deaths than have been publicly detailed in these countries, and there's just simply not a lot of testing going on in some of these locations. Now, in terms of the global economy, this is an industry that is really joined at the hip with the economy, and the insurance industry in each country, I think, knows that well. It's certainly the case here in the United States. So COVID-19 spread rapidly around the world, impacting all regions, but there's no question that the so-called advanced economies have been the hardest to hit. So So these are the latest forecasts from the International Monetary Fund. And what you are seeing here is actually about a half century's worth of GDP growth going all the way back to 1970, with advanced economies in red, and we've got the emerging economies in blue and the global economy in green. And what you have seen clearly on the right-hand side of this chart is a very sharp dive among the advanced economies, who, at least in terms of economic activity with the shutdowns, had the most to lose. So this sort of mirrors what happened back in the financial crisis, where advanced economies with the most advanced financial systems and with the banking sector being the core of the crisis saw the largest economic downturns. And that is the case this time as well. At this point, we're hoping for a fairly rapid uplift beginning in the second half of this year and into 2021. But nevertheless, the scars of this crisis are going to be visible for many years to come. And we had only just recently left behind or erased the last of the scars from the financial crisis. So these types of events are very long lasting. When we look at a few select large economies and we look at the GDP growth situation, so I've contrasted 2019, pre-COVID obviously, with 2020 and then the outlook for 2021. So what you see is, with the exception of China, every country shows a very sharp downturn in 2020, typically in the range of about 6 to 7% in terms of the downturn. China eking out maybe about 1% growth, we'll see. And then most economies looking at 4 to 5% growth in 2021. So we are not going to make up for all the lost growth in 1 year. It'll take several years. In the United States, and in my view, it will take into 2022 before we get back to where we were in the fourth quarter of 2019. So it could take longer in some of the Eurozone states. China's a bigger wild card, we'll have to see. But if I break it down by region and we look at the advanced economies, so you see really the largest downturns in the so-called advanced economies on the left, but also in some of the Latin American and Caribbean economies over to the right. There you have some other issues as well, countries like Venezuela and so forth, also with problems. But you do see the sharpest rebound in the emerging markets in developing Asia. Now, that doesn't mean that there aren't issues there as well, particularly dollar-denominated debt in many of these countries, and the question of whether or not these debts, whether these countries will remain solvent and be able to repay their debts, or corporations with dollar-denominated debt in those countries will be able to make good on those obligations. But if we think about other dimensions of this pandemic that are impacting the insurance sector, I'll talk a bit about this in more detail when I talk about specific lines that are impacted. If we look at, for instance, the annual change in merchandise trade, the trades of goods, not services, just goods, flowing across borders, we can see that we already had seen a deceleration in 2018 and 2019. That has a lot to do with protectionist sentiments in the United States and other parts of the world, raising of tariffs. And we were facing that problem in 2020 as well. But 2020, what we basically saw with the shutdown of the global economy, just an unbelievable contraction in global merchandise trade. So we would expect to see a sharp rebound in 2021, but again, there are many unknowns about the magnitude of that. Looking right here in the United States, just focusing in on economic growth here, we went from growth in the 2 to 3% range in 2019 to negative 5% in the first quarter of this year, down to an estimated decline of about 25% in the second quarter of this year, bouncing back in the second half of this year. But you could see just a return to modest growth in 2021. So that's why it's going to take quite a while to simply get back to the starting line in terms of total economic output. And of course, that has very significant consequences for property casualty insurers and reinsurers, because this is where your exposure growth comes from, right? And when we look at GDP, it consists of consumption expenditures, which in the U.S. account for 70% of GDP. We intentionally put the U.S. economy into a coma, and obviously there was no way to spend money. Business investment is another large component of that. That contracted radically. International trade, import-export is another large component, and we saw that that contracted as well. So you take all these contractions in the individual components of the economy, you get a recession. And so the longest expansion in peacetime history has come to an end after 128 months, unfortunately. So we are now 4 months into a recession. Fortunately, I think the official recession will probably last maybe 6 or 7 months before we're officially deemed to be back into growth mode. But just to give you an illustration of how closely tied the fortunes, at least measured in terms of growth, the property casualty insurance industry is in terms of the related to the economy. If we look at year-over-year direct written premium growth, DWP in blue, and we look at year-over-year GDP growth, nominal GDP growth, you can see that in orange, these are very tightly correlated series, and we expect them to both trend downward as once we get data for 2020. We don't have any finalized data for 2020 yet for the insurance industry, but it's absolutely going to trend down, maybe with a little bit of a lag. Now, the other sad part of the story, of course, so there are many sad dimensions to COVID-19, but of course the mass unemployment. It is estimated that COVID-19 and specifically the economic shutdown that we saw across the world cost the global economy about 300 million jobs around the world. So here you can see the expectation for the annual unemployment rate in major economies around the globe. And for a couple of them, I put in what the current monthly rate is. Now, so in the US, it's close to 15%. That's the most recent number. In Germany, the most recent is close to 6%. And in China, it's about 6% as well. But you could see some of those numbers are going to continue to migrate upward as newer data come in. In the US, we're expected to peak in June at close to 20%. And you can see that more strongly here. This is unemployment rate data for the U.S. on a quarterly basis. So it's totally shocking to believe if we were sitting here in January or February where we were looking at the lowest unemployment rates in half a century, if I were to tell you that within 120 days we would have the highest unemployment rate since the Great Depression, no one would believe me. But that's exactly what is happening. And you can see how the unemployment rate simply blows away the peak that we saw during the financial crisis. So again, extraordinary implications for the insurance industry. Now, I think it's important to keep in mind here, many people discuss COVID-19 as something that was completely unanticipated. We never could have anticipated. I disagree with that. We've had many epidemics and pandemics, not only in global history, but even in relatively recent American history or world history, so-called Hong Kong flu, 1968 to 1970, killed over 1 million people worldwide, including 100,000 in the United States, which works out to about 165,000 if you adjust for population growth. Similar for the Asian flu back in the 1950s. If you ask someone today who's of age, old enough to remember the late 1960s, early 1970s, and you ask them, do you remember the great pandemic when they closed everything down when 100,000 people died? And the answer will be no. It's because we approached it very differently then. In fact, there were really no business closures at all during that time. So the black swan event here was not the coronavirus itself. It is actually the unprecedented decision to essentially, as I mentioned, put the global economy into a coma. And the consequences of that are what are going to be felt for many years to come. And these are the most significant that are driving the impacts on the property casualty insurance industry, which is what we're going to discuss now. So we're going to talk about some of the direct impacts. There have been a number of estimates associated with what the impacts could be on the P&C insurance industry in terms of insured losses. And they are, in some sense, the range is so wide on these as to potentially be useless. But nevertheless, this is the guidance we have. So, for instance, if you look at, most of these are generated by investment banks. But if you look at a recent May, Willis Towers Watson estimate, it goes anywhere from about 11 billion to 140 billion from the low end to the high end. And in the darker orange area is more of the sort of moderate scenario type of outlook. If you had to coalesce around a number, you might coalesce around $60 billion in terms of global insured losses. These are property and liability losses, not life, not health. So not really much in the way of mortality risk generated here. In terms of pure property losses across the world, the estimates from are broken out for a number from a number of the institutions I showed on the previous slide. And you have losses ranging anywhere from maybe, depending on the region, as little as 2, but as much as 15 billion in the United States. So the U.S. and Europe, excluding the U.K., and then U.K. would expect to see the lion's share of the losses. Where will those losses be when you look at key lines? Well, there are 2 areas to focus on, I should say. This would be a business interruption and contingency coverages. Contingency meaning such things as event cancellation. And let me just break down the slide here. Green is sort of the range for the optimistic scenario. In other words, a pandemic that's relatively well contained, those sorts of things. We are able to reopen on a schedule that gets us to complete reopening within a reasonable amount of time. Whereas the pink or purple part of the bar represents a pandemic that's much broader and longer lasting and maybe with more drastic policy responses. So you see the largest potential impacts from business interruption and contingency in the U.S. and the U.K. But the largest impact potentially overall is workers' compensation, which does not necessarily have a perfect analogy in many other countries. But the severe scenario here reflects potentially very large numbers of workers who are considered essential workers coming down with COVID-19 and those costs being very, very high. And in the United States, we have an issue with presumption. In other words, workers who are beyond doctors, nurses, and so forth, and first responders being potentially considered individuals compensable. So this has been a concern for insurers here. But beyond this, many of the losses may be manageable, but from a manageability standpoint, it is the business interruption and the workers' compensation situation in the United States that is of greatest concern. So that was in terms of loss. In terms of premium impacts, because we have to think about all this in the context of a shrinking economy and shrinking exposure base. Workers' compensation is a direct function of payrolls, and payrolls are being eviscerated as the unemployment rate skyrockets. So the expectation is for premiums and workers' compensation to shrink by 12.5% to 25% in 2020. For business interruption and contingency, as much as 13%. Excuse me for a moment there. And general liability, up to $6.3 billion loss in the U.S. And if we, in terms of something like personal auto, potentially as much as $10 billion in the U.S., Travel insurance, very large share of that market as travel has ground to a halt. So the majority of that premium is actually at risk. And when we look at personal and commercial motor coverage, around 10% in the US and potentially around that much in the UK. And as I already showed, trade is down tremendously, so we could potentially see significant impacts on the marine, aviation, and transport sector as well. Not potentially, we definitely will. It's just a question of where we wind up. And a few other lines here for loss impacts. We could look at workers' comp. Again, I already mentioned that, potentially very large losses there. Business interruption, very large potentially in the US and the UK. GL, depending on the degree to which lawsuits break out as businesses begin to reopen. And when we look at also losses for motor insurance, however, we're talking about a reduction. With less driving activity around the world, we actually expect to see very large reductions in loss payouts by motor insurers around the world, both personal auto as well as commercial motor insurers. We'd also expect to see a reduction for in the marine, aviation, and transport area as well. So there are many lines that are going to shrink, and the largest really in the world, I believe, will be personal and commercial motor, as well as U.S. workers' compensation will see the largest shrinkages in the world in terms of their size. Now, moving along from there, when we think about the impacts on profitability, in some sense, we don't have a lot of data to go by here. The P&C insurance industry was profitable in the late 1960s. And if I look back at the last 5 economic downturns back to 1971 for some guidance to see what happens in terms of ROEs, we see that the median decline in ROE over the last 5 economic downturns, at least in the U.S., was 5 percentage points off the ROE. So that might take us from about an 8% ROE in the U.S. down to maybe a 3% ROE in 2020 when all is said and done. But again, that's a lot of speculation because we still have not, literally in the United States, for example, hurricane season began just yesterday. So there are many other things that need to be included by the time we get to the end of the year. So it begs the question, however, are pandemics an insurable risk? And many people will immediately say no, and some may actually say yes. When we look at the economic costs from pandemics, we can see that the World Bank, for instance, has estimated that the global cost of the COVID-19 could be some $9 trillion. It could actually wind up exceeding that depending on what you include in the economic loss estimates. Clearly, without even thinking about it, that vastly exceeds the claims-paying resources of all insurers and reinsurers on the planet many times over. So that the point in some sense may seem decided right then and there. There's no way that it is an insurable risk. And if you look at the other major pandemics we've had over the last several decades, these are very, very costly as well, and very often measured in terms of trillions of dollars as well. In the United States alone, we've estimated, and I do some work with the American Property Casualty Insurance Association, APCIA, that monthly business continuity losses, in other words, the cost of keeping businesses closed in the United States, in terms of lost sales and some other elements of this, is about $1 trillion a month in the United States alone. Compare that into a capital base of about, for the P&C insurance industry, of about $800 billion. So clearly, talking about business continuity exposure risk as an insurable risk is really a non-starter. Let's compare the size of COVID-19 insured losses to traditional natural disasters. For the most part, what we can see is that over the last decade, 2010 through 2019, we had average annual insured losses of about $35 billion from catastrophes. And in the decade prior to that, it was $25 billion. In the 90s, it was $15 billion. In the 80s, it was $5 billion. So it's going up about $5 billion a year, even after you adjust for inflation. But again, the business continuity losses from COVID would simply dwarf that if insurers were required to pay such losses. So it really casts doubts on the insurability of it. So when you think about $1 trillion in business continuity losses for 1 month, that is many times even Hurricane Katrina, even after adjusting for today's dollars. So again, no comparison here whatsoever. Where COVID-19 insured losses, at least on the property liability side, wind up is anyone's guess at this point, but there's no question, at least from a property perspective, we could wind up in the top 10 or 15. We'll simply have to see. So when I think about insurable risks, I go back to a slides that I use even with my students. Not all risks are insurable, and I won't run through this slide, but I think it's a useful slide that I put together specifically to address whether or not pandemic risks addresses what I consider the 6 essential criteria for an insurable risk. And these revolve around whether or not the loss can be pooled and those losses can be diversified and distributed across a larger population. And generally speaking, those conditions are not met with respect to pandemics. I put all this in a paper that I've co-authored and was just released last week about the uninsurability of mass market business continuity losses from viral pandemics. And you could download that at the PCIA link here or at uscriskcenter.com, where it is available for free. But where we go through in great detail the reasons why the business continuity losses are certainly, generally speaking, are not going to be privately insurable, with some very few exceptions. We do talk about where there are some possible opportunities for the private sector, obviously such things as event cancellation and so forth, and under most scenarios, workers' compensation, travel, and so forth are manageable within the private sector, but business continuity losses, generally speaking, are not. Now, moving on from here, what would be the impact from an investment perspective? What I did here is I took a look at some of the impact, some of the policy responses associated with COVID. The immediate impact, of course, was for most insurers to sustain fairly large, although generally unrealized, losses on their investment portfolio. It was in the neighborhood of about 10 to 12% in the United States in terms of reduction of the P&C insurance industry's surplus. Many private insurers saw similar declines, of course. Some realized declines. And then the policy response, of course, was to lower interest rates. So around the world, what we have seen is a reduction in the rates being charged. Sorry, not rates being charged, that the central banks lowered rates all around the world. And what we saw was interest rates in general fell in response to not only actions by central banks, but of course the perception and the reality of economic weakness. So in the United States, for example, prior to COVID, standing on December 31st, the U.S. 10-year Treasury bond was sitting at 0.7%. Well, we lost 173 basis points on that as of May 23rd. We dropped 112 basis points in Canada, 78 basis points in the UK. In Germany, where interest rates were already essentially zero, now they're negative and even more negative, and you can see where we were. We were not talking about interest rates that were generally very high pre-COVID, but they are even lower today, including moving even more deeply into negative territory. So in the U.S., interest rates fell off a cliff, as you can see, both for shorter-term yields, the 2 and the 10-year. This is, in between that is where insurers tend to invest, and so this is more pain on the investment front. So I'm expecting that we will see, for instance, in the United States, the yield on the investment portfolio to drop in 2020 to about 3% from 3.1 in 2019. And this comes on the heel of many years' decline that began during the financial crisis and the very long period during which interest rates were kept low after that. We saw significant drops in stock markets around the world as well. However, there's been a recovery in many markets. So what you are seeing here is this is the decline relative to 31 December 2019. So as of May 23rd, so in the U.S., we were down only 8% after having the S&P down 34% on the 23rd of March. So all the major markets have made some recoveries since then. In fact, as of yesterday, the U.S. is down just 5.4%. So it's entirely possible that in the United States, we could see positive returns on the S&P 500 for the year, despite having seen some of the largest shocks in the equities markets that we had seen since the Great Depression. And so this is what we are seeing as of yesterday, down about 5% for the year for the S&P 500. That would be truly extraordinary. What that means is the markets are anticipating a so-called V-shaped recovery. In other words, a relatively rapid economic recovery, at least in the United States. That may be wishful thinking to some extent, but the markets are forward-looking, and the markets are definitely beginning to price in the expectation of a vaccine sooner rather than later, meaning very early 2021, not the second half of 2021. And that does make a big economic difference. So as I mentioned, we saw a pretty substantial hit to the industry's policyholder surplus in the first quarter, though that will moderate as long as the current reflation of asset prices continues. I want to conclude on a couple of topics here related to litigation, legislation, and regulation amid the COVID-19 pandemic. In the United States and around the world, there's no question insurers have received tens of thousands, and I dare say by now potentially hundreds of thousands of claims related to COVID-19. This does not mean that these claims are all compensable. There are more claims, for instance, in the United States being filed, business interruption claims, than any other type of claim. The vast majority of them in the United States are not compensable because of policies that preclude coverage for viral or any risks or any other type of microorganism. And workers' compensation may or may not be compensable. There are certainly significant losses, as we discussed, in areas like event cancellation and travel insurance, but those are all transient in nature. And GL remains to be seen as we expect the litigation environment to evolve. I should mention that in the United States, as we are currently having discussions today for a fourth round of stimulus, federal stimulus, as part of that, the Republican-dominated Senate is looking to incorporate liability protections for businesses as they open up. So in the United States, the most tort-happy venue in the world, lawyers are already advertising on television seeking to sue everybody and anybody in the event that a case of COVID arises, say at a restaurant that happens to reopen. So businesses are looking to cover themselves in this instance by taking reasonable precautions. They hope to be protected under the law, at least for a period of time. So that legislation is out there, and that will have a potentially very large impact on the outlook for general liability in the United States. But trial lawyers are well known to never let a crisis go to waste. So they are looking very hard here, scouring coverage to find coverage where none exists, find coverage where none was intended, and to find coverage for which no premium was paid. And as is typical, politicians in the United States are piling on to this. And I know there's some discussion about this in the UK as well, and also in countries like France related to the business interruption issue in particular. But in the United States, the vast majority of business interruption policies contain language along the lines of the following. This is the standard language from a standard policy, essentially saying that that business interruption will only be paid when there is direct physical loss or damage from a covered cause of loss. And what insurers are arguing is that COVID does not create any physical loss or damage to the property. And beyond that, it is not a covered cause of loss. And then so that language exists in essentially all policies. And then in the vast majority of policies, or at least an overwhelming majority of policies, there are separate virus or bacteria exclusions that essentially list viruses as an exclusion very, very specifically. So, but that does not stop some politicians in some states from attempting to override this. So at least 7 states in the United States have some sort of legislation, although not approved and not passed into law, that would override the language in insurers' policies. So for instance, in Massachusetts, language that says no insurer may deny a claim for the loss or use and occupancy of business interruption, and even when there is a virus exclusion in place. Or even when there's no physical damage. So it's saying it doesn't matter what contract you entered into with your clients, with your customers, even if it's completely legal, even if it is approved by the regulator, we are going to completely ignore it and make you pay money for which no premium had been collected. So that's a problem for reasons I mentioned earlier. All business continuity losses in the United States would tally up to $1 trillion a month. If we just looked at small businesses, if you look at the left-hand side of this chart, the 2 bars on the left-hand side, if we just look at small businesses and assume that only that have business interruption coverage, but who have relatively minor business interruption losses, nationally, this still adds up to $52 billion per month in terms of insured losses in that scenario. If we look at all small businesses, again, businesses with just fewer than 100 employees, whether or not they have business interruption coverage, because some legislation would compel insurers to pay that, it's up to $430 billion a month. So you can see how quickly this would be a problem for the industry. Now, we don't quite have time to get through all the alternatives that have been proposed out there. There has been a proposal to, there has been legislation, in fact, introduced just a few days ago called the Pandemic Risk Insurance Act, or TRIA. It is modeled after the well-known Terrorism Risk Insurance Act, or TRIA, and that's part of the problem. Pandemics are barely even superficially like an act of terrorism, and so by usurping the TRIA legislation, which has worked quite well, but fiddling with it in certain ways that would create a potential substantial burden for insurers, this is a program that insurers generally do not support. So the most recent iteration of the program actually would be capped at $750 billion, but it would require insurers to pay 5%, essentially a coinsurance provision of 5% of all losses above $250 million, which the industry will need to retain. Now, so this has real balance sheet implications for insurers and reinsurers, whereas TRIA does not, because under TRIA, the reinsurance is essentially provided free of cost by the federal government, whereas under this Pandemic Risk Insurance Act, there's a standing liability equal to somewhere in the neighborhood of $35 billion for the industry. So that has impacts on balance sheets. And in addition, we're talking about a program that would be simply overwhelming for insurers. If for example, the losses would be so enormous, generating millions of business continuity claims essentially simultaneously, and in dollar terms, that it would be larger than all of the top 10 largest property casualty insured disasters in history, plus all the losses from the federal co-op insurance program, plus all the losses from the National Flood Insurance Program, happening instantaneously. So there's not enough capital, and there's not enough essentially logistics, in other words, claim-paying resources on hand to manage something like that. So for those and other reasons, the industry does not support it, and is supportive of another program called the Business Continuity Protection Program, which in fact would be a program in which insurers would, along with other institutions, would act as administrators, as a conduit for paying business interruption losses. But there would be no actual risk transfer to the insurance industry. So let me conclude, and then we'll have time for some questions. It's very fortunate that this industry, the industry we all know and love, really entered this pandemic from a strong, stable, sound, secure financial standpoint on a global scale. And that's exactly how you'd want it. and that's exactly what happened. So insurers were able to withstand the shock, the financial shock waves, what we saw in the financial markets, what we're seeing in terms of the economic downturn, and what we're seeing in terms of losses. So the three tsunamis happening in rapid succession to the property casualty insurance and reinsurance industry, and the industry will emerge on the other side of these tsunamis, again, strong, stable, sound, and secure. Asset price volatility, that is going to remain with us for a period of time. I wish I could say that it would not, but there's no reason to believe that it's been vanquished. So there are going to be shocks in the months and in the years as we continue to make our way towards recovery. And at the end of the day, I believe that the COVID-19 exposures are substantial, but on a global scale, but they are manageable, assuming that we do not have some sort of currently unanticipated litigation or legislation that would essentially put insurers and reinsurers on the hook on a retrospective basis, again, for losses for which had never been priced, had never been a premium collected, and so forth. That would take some very unfortunate legislation and litigation, which right now I don't believe is likely, but we need to guard against both here and internationally. But you should expect to see some continued headline risk related to the business interruption, and in the United States, the workers' compensation issue in particular. So, Mike, that ends my portion of the presentation. If you'd like to take it away and bring us to the Q&A, but just as a reminder, you can download this on the IIS website or at uscriskcenter.com, where you'll find many other presentations which come up just about every week. Thank you very much.
Thank you, Bob. I've had the pleasure of hearing a number of Bob's presentations over the years, and there's sometimes a sensation of drinking from a fire hose. But Bob's unique ability to present this large volume of information in a cogent way is really commendable. So thank you very much. We do indeed, reflecting the large amount of different information here, a number of questions that I'll try to work through. First of all, there have been a number of periods over the decades I've been in the business when the industry was profitable for a while, and commentary started to emerge that the industry was overcapitalized to an extent that it couldn't provide an economic return on capital. And then something happens and it doesn't look so overcapitalized after all. Within the general framework of the global industry remaining strong and stable, how do you feel about the capital adequacy and maybe more urgently about liquidity right now?
Yeah, so let me actually take the liquidity question first. So the issue of liquidity was one of those, that was the tsunami that happened almost within hours of the closures becoming widespread around the world. So we saw the collapse in the equity markets around the world, but a little bit behind the scenes, but very visible to insurers who are very large fixed income investors. We saw essentially a seizure in fixed income bond markets, and so we saw massive intervention on the part of central banks around the world, including the Federal Reserve here, who not only lowered interest rates, but in order to unseize the markets and restore liquidity, began a massive bond purchase program, not just of treasuries, but also of investment-grade corporate bonds, more recently electronically traded funds, things like this. So central banks around the world did what they needed to do to restore liquidity, and that liquidity is important to large institutional investors like insurers, like banks. Okay, so insurers on their own do the best that they can to remain liquid in the sense that they have fairly conservative portfolios. They have relatively short durations in their portfolio, but nevertheless, when the wheels begin to come off the global economy, that gets beyond the ability of insurers to manage on their own. So we did see a very large decline in the value of even investment-grade bonds. AAA bonds even fell significantly in value in March of this year. Much of that asset price has been restored since then. So I'm feeling comfortable about the insurer's position going into the crisis, and I'm feeling comfortable about how central banks manage the liquidity issue. In terms of overcapitalization, yes, I can't tell you, Mike, how many times over the years I've been told, not only by investment banks, but also by critics of the industry. The industry has too much capital. You're charging too much. You should return the capital to policyholders and so on. And then an event like this happens, and people are very glad to hear that the last thing that they have to worry about is whether or not their insurer is going to be there tomorrow. And so there's a lot of peace of mind that we're entering what's expected to be an above average hurricane season in the North Atlantic, and coming on the heels of COVID-19. Yet nobody is saying, what you're not hearing on any of the news networks or on Bloomberg or anywhere else, is whether or not the insurers can fight two wars on two different fronts at the same time, when in fact this industry can do exactly that. So I feel, well, in technical terms, one could argue that the industry is overcapitalized. I think that what you are likely to see going forward is there's some reduction in capital because of COVID-19, but you are also seeing on a global scale, for most key lines, you are actually seeing an adjustment in rate. So you are likely to see, after the initial shock of COVID, you are likely to see what is a fairly substantial firming market, and some people call a hard market, which will restore rates of return to what would be considered more risk appropriate for the risks that we are facing today.
Well, as a matter of fact, there was a cluster of questions on that very subject, and that is the potential hardening of the market. Now, John Neal, chairman of Lloyd's, said recently, we're not in a hardening market, we're in a hard market. And that's even without knowing what the storm season may bring. But do you think this is going to be an extended hardening market, or just a blip to recover from this one event?
I think there's a sufficient amount of uncertainty around COVID and a sufficient amount of capital that has been, maybe not, the word isn't lost, but we should say where asset prices have declined, that the firming market or the hardening market has some legs on it, in the sense that it could certainly last through the end of 2020 and into 2021. If we also have on top of this some significant traditional property related losses, say major hurricanes in the North Atlantic, severe wildfire season, winter storms late in the year in Europe, these sorts of things, the typhoon season we'll see in the Western Pacific later in the year. All of these can produce additional losses and pressure on property markets and on reinsurance markets. Maybe it's a matter of semantics and a matter of your geographic location and your business mix, whether we call it a hard market or a hardening market or a firming market. But there does seem to be more firming than at any point that we have seen in quite a few years, and there is likely to be some duration associated with it. Now, on the flip side, as I mentioned during the presentation, there is an enormous amount of exposure being lost. The economy is weak, and that means that insurers are going to be competing for a shrinking pie around the world. And so it is also the case that insurers tend to compete intensively to keep business on their books, particularly if it's a solid piece of business. So that has the potential to work a bit in the opposite direction, or to at least diminish the intensity of a hardening market, especially for better performing accounts.
That's an observation on the flip side of the hardening market that I hadn't heard before. It's worth keeping in mind. Bob, we've been hearing a lot about businesses in the United States in particular, perhaps being granted certain liability protections to protect them from lawsuits as the economy reopens. Is this likely to happen, or is this just rhetoric?
Yeah, so as I mentioned during my talk, this is ongoing conversation in the Senate, the Republican-dominated Senate in the United States, which does support inserting liability protections for U.S. businesses in the next round of relief funds, stimulus funds that are likely to be passed by the U.S. Congress sometime this summer. Now, it is currently opposed by the Democratic House.
Right.
The president may have said a few words about this. I don't know. I'm not sure how well informed he is about this particular issue at the time. It is the case that in the United States that hospitals and other medical professional and medical delivery systems have already received some limited amount of liability protection, because obviously with some hospitals overrun by COVID, there was a high fatality rate, and of course they were rightly concerned that they were going to be sued out of existence. And what good would it do to have to close a hospital that's treating COVID patients simply because trial lawyers have put them out of business? Well, that wouldn't serve any public good whatsoever. While the same argument can be made in a larger scale, what good would it be, or what good is it to have businesses of all sorts? We're not just talking about restaurants. We're talking about educational institutions, which are hoping to reopen in the fall of this year with students worried about being sued if and when. And we all know that COVID will not be stamped out comes August and September and October of this year. So I'm hopefully optimistic that some limited liability protections, limited in the sense that they will last for a certain period of time, and limited in the sense that if a business is guilty of gross negligence, they could still potentially be sued. But under most circumstances, for instance, where a business can be shown to be reasonably adhering to local health ordinances, CDC guidelines, or the guidelines of their local health officials, that they would be protected from litigation in that instance. And I think that is important to the pace of recovery, but it's also very, very important to the potential outlook for property casualty insurers, because the general liability line in particular, as well as a few other liability exposed lines, are very, very hard to see where they are going to wind up unless we have a good sense of the outlook for the tort environment. And that depends very substantially right now on how the U.S. Congress acts this summer.
Bob, you've pointed out that pandemics are not really a rare occurrence in our world, and now in a globalized world, and one where public health systems have been shown to be generally inadequate, we will have more in the future. Are there any kind of pandemic virus, bacterial risks that are insurable that the industry can reasonably offer protection on?
Yeah, that's a good question, Mike, because I want people to understand, and hopefully if they download my paper, they will understand that the greatest argument for uninsurability is really associated with business continuity. In other words, business interruption risks. Now, does that mean that there are not potentially opportunities for private insurers to assume limited amounts of risk? No, it doesn't mean that at all. So some examples, again, would be the event cancellation type coverages. Insurers can have a lot of experience with that type of risks for those sorts of exposures being canceled or delayed for a wide variety of reasons. And while pricing may need to be adjusted and the terms and conditions of coverage may need to be adjusted for a period of time, insurers can definitely operate in that market. And there can be multi-billion-dollar losses in that line, but that is manageable. Those are very carefully underwritten types of risk. When we think about such things as trade credit, okay, I believe that's a manageable risk in the sector. And we had issues with that. So the non-payment on the other part of an export-import transaction, those sorts of things. Obviously, such things as travel insurance, which is sort of small in the scheme of things, but the losses could are potentially large when all is said and done. So there are opportunities around the edges, even in some areas where if the government is participating in business continuity programs, it's possible that, for instance, private insurers and reinsurers could operate and offer products on an excess basis, or they could offer coverages that are triggered on a parametric basis, so that if a pandemic is officially declared and meets certain other criteria, a certain sum is paid, for instance, to compensate for disruptions in supply chains, which are an issue. So whether or not the premiums associated with some of these products are economically feasible, in other words, are they affordable? Do they make sense? Nobody's going to buy an insurance product where the premium is as much as the potential loss. But I believe that we'll see a lot of creativity, as we always do. Creativity, ingenuity, innovation, as well as capital attraction into global specialty markets, into places like Bermuda, into various captive sorts of structures around the world. So I think there will be interest in this going forward. And I think if we were to look back at this 5 years from now, we might even see what you might call a class of 2020 or class of 2021, which would be some very specialized insurers or sidecar type arrangements, which assume a very limited amount of pandemic risk. And we saw some of this in the wake of 9/11, and then we wound up with TRIA. And so now we have TRIA, we have a standalone market, and we have private exposures, we have TRIA-backed coverages as well. So it also partly depends on when and if some sort of government program emerges. So for instance, if businesses are going to be responsible for a certain amount of loss before they're eligible for government payouts, potentially that capped loss could be privately insured as well. So a lot of questions, but I do believe there are some limited opportunities.
Well, on that optimistic note, I think we have to bring the Q&A session to an end. As happens with the better presentations, we have more questions than we do time. So at this point, I must ask Bob if he has any brief closing remarks.
Well, Mike, I do, and thank you again for having me here at this forum today. I think that everybody who's listening today and who's involved in this industry, whether in the U.S. or abroad, whether you work for a primary insurer or reinsurer, you should be very optimistic about the future of this industry, and you can be very optimistic about the performance of this industry in the current pandemic. As I mentioned already, this industry has seen in quick succession 3 tsunamis, a financial market tsunami. We're seeing a loss tsunami right now. Yes, we may see some tsunamis in terms of litigation and so forth. But again, having entered very well capitalized, and I think coverages being fairly well written for the most part, what we are seeing is a risk that is manageable and prepared to take on risks like these of the future.
Thank you again, Bob, for these great insights. They have enormous bearing on our industry's future. And also thank you to our attendees from around the world for participating and sending in quite a few thought-provoking questions today. And so for today, on behalf of the IIS, this is Mike Morrissey saying thanks and goodbye.